You're listening to Conquering Retirement with Annuity FY. Real strategies, real stories, no sales pitch. Join Tom Hamlin and his expert guests so that you can make smarter moves faster. Hit that subscribe button and let's conquer retirement together. Welcome, everybody. It's great to have you here. Thank you for joining me again on this episode of Conquering Retirement with Annuity FY. I have Brian Hamlin here today, as always, the wonderful Brian Hamlin. Tom Hamlin, I have you as well. Brian is I work with every day. Tom has been in the industry for 35 years now. Hopefully, if this keeps going, you'll help me say 36. So exciting. Great to have you here. Yeah. All right. Well, in today's episode, we're diving into part 1. So stay tuned for part 2 of the 8 eternal truths of investing. We were inspired by a client question as always. So thank you so much for your questions and keep writing in. The question that we had was, I've worked hard, saved diligently, and now I'm retired. But with the market swinging and all of the headlines, I keep wondering, am I doing the right thing with my money? What are the timeless principles I should be following to protect what I've built and to make it last? Really wonderful question. Tom, this got me thinking about something that you always bring up. It's which is the 8 eternal truths of investing, which is why we're kind of going ahead and talking about those 8 eternal truths. On this episode, we're going to go through 4 of them, and then part 2, we'll go through the next 4. So like I said, make sure to tune in. But Tom, why don't you take it away and just go and give some background on how you learned about the 8 eternal truths.
Yeah, thanks, Meg. And yeah, thanks for giving me a little heads up on this one because, you're right. I've been using these for my entire career, 34 of my 35 years. 1991, I was at the Ritz-Carlton on Admiralty Way in Marina del Rey, California. First day with a new tongue. And our company was based very close to there, probably a half a mile away. And it was a big conference. And I sat at the table with the world famous global investor, Mark Mobius. And and so he sat at our table and had a great conversation with him. I was honored to sit right next to him. And we ended up going out on our boss's boat. And I felt more comfortable after a few more pops. And Mark doesn't drink. And this guy looks like a futuristic human. He's one of the most brilliant people I've ever met. And he speaks, I think, 8 or 9 languages, most of them Asian, even though he's an American. But the bottom line is he shared with me the 8 eternal truths of investing. He said, Tom, if you write these down, internalize them, and never forget them, you'll be fine. Because I'd only been in the business about a year at that point. So with that being said, Mark Mobius was with Franklin Templeton. He was with Templeton and then Franklin together when Franklin bought Templeton. Sir John Templeton was the founder of that company. But all that being said, they come from a great place. I've been using them all these years as somewhat of a beacon in my career. And why don't you go ahead and we'll dive into them.
So number 1, all investments go up and down. Seems pretty straightforward, but is it just that? Is it more complex?
I was told, the market, you can kind of liken it over time. It's like, using a yo-yo while you're walking up a hill. And I like that one because the yo-yo's in the short term, lots of ups, lots of downs, lots of ups, lots of downs. But over time, you're slowly making your way up that hill and you look back, you're a lot higher than when you started. And I have a story about this. I had, I'll hold off. My story's better for number 2, actually. But
don't tell him yet. Don't tell him yet. Don't say anything.
Tom, save me. Please.
Yeah. So all investments go up and down. is more liken that statement to, well, it's real estate, it's the stock market, it's bonds if you're trading them, because if interest rates rise, the value goes down, and if interest rates fall, the value goes up, and you still get your coupon. So yes, all investments do go up and down. It's based on simple supply and demand economics. And, the items and services are worth what people will pay for them at any given time in the marketplace. And in terms of all investments going up and going down, having been in this industry for 35 years, I have not just read about it, but I've seen how people behave. I've helped over 6,500 people, clients in my 35 years, and I've dealt with all different types of people, from people that had $10,000 to people that had well over $10 million. And I've learned a lot from them, and especially the older people, because as the Germans once said, "Wir alt too soon and smart's too late." The youth is wasted on the young, and don't make me laugh. Don't make me laugh. But truly, wisdom comes with age, and unfortunately, by the time that we figure out how things really work, because no one listens to their parents, except Hammy, you're pretty good. Um,
Oh,
the
Good job.
We don't learn these things until later. I've been in this business for 35 years, and I've seen the good, the bad, and the ugly, which I often reference in terms of lots of things, not just the fact that it was a good Clint Eastwood movie. But when it comes to all investments going up and going down, um, it is time in the market, not timing the market. It is staying the course. It is understanding your risk tolerance and what you can handle. Because the problem with the stock market is that it's not the average returns that most people receive. It's the sequence of returns that happens along the path that have people either getting excited when it's high and getting paranoid and freaking out and capitulating when it's low. And if you could just reverse those two emotions, if you felt like you should buy and you sold, and you felt like you should sell and you bought, you'd be a significantly better investor, because most people get that wrong. I literally used to I wrote it down on a piece of paper, and then I put it in the computer. Of course, we had
Can I
pen and
pause you
paper when
there?
we got in the
Can I
business.
pause you there, Tom? Because I think we've actually merged
don't
into two.
Stop giving me the finger.
don't.
Oh, well, just because I think we've merged into two. So I want to, so maybe we should just go ahead
Oh, I
and
did?
state
You're giving the
two.
sauce away.
Yeah,
I
You're giving the
did?
sauce
exactly. So
away.
maybe I should go to
Wait, I was
number
on a
two.
roll. Where
Oh, no,
was
it's
I?
going to two. No, investments go up and investments go down.
Wait, what was
volatile.
this? I was going to tell this great story.
Because you're literally going into
Now I
Going
don't
into
remember what I was
emotions and
gonna say.
behavioral finance.
Shoot, hold on a minute. Now hold on. Pause.
Okay. So number two is, I think we're all excited about this one, is most people do the wrong thing at the wrong time. And I know Tom has a lot to say about this one, and Brian has been holding off, so thank you, Brian. But let's take it away, Tom.
Thank goodness for edits. So,
It's where Abby makes her money right
yes.
there
Yeah,
on that last one.
This is where our secret producer is coaching us. So anyway, most people do the wrong thing at the wrong time. There's no secret here. Everyone knows buy low, sell high. As a matter of fact, many years ago, I actually had a little 8.5 by 11, and it literally had two boxes on it. The first one said, buy low, sell high. The second one said, buy high, sell low. And I put their name on it, and I had them sign it, and I put it in their file. And inevitably, if I did, say, a large cap, mid cap, small cap value approach on one side, and a large cap, mid cap, small cap growth approach on the other side, that's a good yin yang that complements one another in terms of strategies. And that's a lot of what we did back in the day. Inevitably, if the growth side went up, I would have people calling me up and saying, hey, Tom, we love that growth strategy side, but not so much the value strategy side. Can we sell the value strategy side and buy the growth strategy side with those proceeds? And I said, do you have that piece of paper that you signed way back when? And they said, well, you'll have to refresh my memory. It's the one that said buy low, sell high, buy high, sell low. And so what you're describing right now is you want me to sell low and buy high. And this is what most people do habitually. And this is exactly why I said, sign this piece of paper, because I knew inevitably that you were going to, and everyone does it. So you're not alone. You're in good company. And so that's why I wanted that in your file. So, shoot, there was one more little point there that I wanted to make, but it's if people would just do the opposite of what they were thinking of doing, they would get it right. Literally, if they thought they needed to buy. Like a lot of people right now are just absolutely buying. Why? Because the market's set at all-time high. They feel safe. There's safety in numbers, but most people are lemmings. They just do what everybody else does. Most people are wrong. So super wise people listening to this podcast would agree with me that buying into a market like we are today, that we have today, is the wrong thing to do if you're doing it now. Okay. Conversely, when the market is down, people will be running for cover. They'll be nervous. They'll be, oh God, the world's coming to an end and the sky is falling, and they won't buy, and they should buy. So if most people would just do the opposite of what they were thinking of doing, when they felt like buying, they should sell. When they felt like selling, they should buy. They would do so much better. And that doesn't mean don't stay the course, but definitely know your risk tolerance. I'll take a pause there.
Well, I just had a story about this. One of my clients, I've had him as a client for a few years. Great guy, and he can get a little bit emotional with these sorts of things. And essentially, what happened here was he was in a variable annuity with no surrender charges or anything like that, and was looking to take guaranteed lifetime income. We ended up finding a fixed indexed annuity option, which would pay him more in guaranteed lifetime income. So that was a natural switch. In this variable annuity, I told him, okay, we're ready to, sell the funds, sell the proceeds, put them into cash so that when the money transfers over, everything's good. Well, he wanted to just stay in the market for, a few more days. He didn't want me to put it into cash. He just wanted to see how the last few days of the market, played out before the money transferred. And guess where that fell? It fell,
January.
between April 6th and April 8th, Liberation Day.
Oh.
And what do you think happened there? He got killed in just those few days, just a few days in the market. And in the grand scheme of things, you have in that situation, you have everything to lose and nothing to gain. You're not in that situation hoping the market's going to pop 6%. You're going to get maybe a little bit more. But what's the downside is that you could lose a lot, and that's going to affect the guaranteed lifetime income for the rest of your life. So that's just kind of a classic example of trying to time the market. And the dates can make liars out of all of us, but generally when you're talking about the stock market, the shorter time horizon you get, the harder and harder it becomes to sort of predict these things. I could tell you, I could make a very reasonable estimate and projection that the stock market's going to be higher in terms of price 10 years from now than today. But I can't tell you if that's going to be the case tomorrow. And, you could get some of the best sort of economic minds or people who, investment managers, so on and so forth, all of them in a room. They all may have different, short-term opinions. And that's why, and I would challenge if you, and annuity FYI, our viewers, if you know a successful day trader that's had a 30-plus year career, really famous day trader, then put their name in the comments. I can't think of one.
They're unicorns.
Yeah.
So a couple things there, Brian, that you touched on that reminded me of the great Peter Lynch. He said, if you don't have 10 years to stay in the market, stay in the money market. And that's profound, because the average stock moves 50% in a year. That's up 50 or down 50. So that's why the S&P 500 works if we have good companies in there.
That's probably a good segue into number 3.
But just real quick before we move into number 3, we always say this is it's time in the market, not timing the market. So to your point, it's all about the average return. The longer that you have, the stronger that can be.
Yep.
Just also make sure you know where your income's coming from. It's a really great idea to have a fixed bucket or something that you can pull your income from, an annuity, for instance, with a guaranteed lifetime income benefit, like you were saying, Brian, so that you're not having to sell when times are tough. And because, you're obviously selling for a reason, right?
Yeah.
So
Some sort
just
of protected
the
bucket. You don't
mhm,
want to be a forced seller in a down market.
which happens all the
2008
time.
hits, COVID hits, and you have to sell to pay your bills. You don't want that.
you
So
definitely don't want to be selling stock to satisfy your income needs
Yeah, and
mhm.
that's why,
in a low market.
And it
and
happens
that's
all
what
the time. Yeah.
That's extraordinary inflation right there if you have to do that.
and you're
Um,
selling at pennies on the dollar. And with retirees, what happens is when you're able to put, obviously when you retire, you don't have your paycheck. You need that safe, income instrument. And annuities do a fantastic job of that, especially right now. But there's other instruments too. But the main point is that you have this sort of protected instrument where you can pull that income from safely. And what you've done is you've bought yourself time in the market with your other money. You've effectively purchased time. It's
Yep.
one of the few circumstances in life where you can buy time,
Yep.
investment time. So
That's great. Um, I think we're on to number 3. So markets usually overreact both on the upside and the downside. We've kind of talked about this a little, but I think that there's so much more to be said.
yo-yo on a hill.
I remember many, many years ago, over 40 years ago, people would get together in people's backyards and do these pyramid schemes. Everybody would show up with $100 and they'd start these parties and if you were in early, people showing up with these hundreds and then you go to the top of the pyramid, then you get cashed out. But and this is like a Ponzi scheme, of course. There's no product, there's nothing. People would get so euphoric and excited. And yeah, you got to go over to University Street, at 913 University Street, because there's a great pyramid over there, and people would show up. And by the time you got there, by the time everybody knew about it, it was too late. And that's kind of like the stock market. By the time everybody's talking about it, if you go to a cocktail party or a gathering and all people are talking about is the stock market, that's the time to head for the hills. That is the time like, ooh, I got to liquidate everything, because when everybody's talking about it and, you're talking to, somebody that shouldn't know a ton about the market and they're espousing their beliefs on where it's going, that's exactly when you need to
I
absolutely
feel like we've heard a
get
lot
out.
of that. I feel like we've heard of a lot of that with the what are those kind of stocks called?
Meme
The
stocks.
meme stocks. Yeah, everyone was
That's just
talking about.
gambling.
Yeah, to
It's
your
not,
point, that it is 100% gambling at that point. A lot of
yeah,
the
that
stock market is too, but that's specifically.
right. Well, when it gets frothy, and that's why, sometimes that's why the complement between growth and value is very good. You want to
Hmm.
buy companies that complement the other side. You can't have all the weight on one side of the scale because it becomes imbalanced.
Do you want to go ahead just really quick for those that don't know what is a growth stock and what's a value stock? Just real quickly.
Sure. Growth stock is a stock that has tremendous momentum. The PE ratios tend to be a lot higher. There's a lot of justification in terms of why it's justifiable that the PE on that stock is 100 when the market's historically trading at 16. And there's and it gets very frothy, and
But would you say a
oftentimes
growth stock
things
typically
return
is
usually things return to the mean.
would you say
Go
a
ahead.
growth stock is different than a meme like stock because it actually
A meme
it is
stock is in a
growing for
league
like
of
a
its
reason?
own. I
Hmm.
don't
Yep.
There's not a lot of fundamental value and underlying value in a lot of these stocks relative to where they're trading.
Hmm.
Okay. So, a stock might be worth 100 million, but it's trading for 2 billion. That's absolutely
Well,
ludicrous.
there's a difference between growth value and just pure kind of speculation.
Yeah.
Mhm. What's the value stock? Yeah.
Value is where you have analysts that are very relatively conservative analysts that are looking at companies saying, I'm not touching that one with a 10-foot pole. It's trading well in excess of its PE ratios and its growth and its realistic growth prospects. And they're looking for companies that are trading at a discount to their brethren, their peer group, and the PEs in general. And so there, it's the proverbial buy low. Oftentimes those companies have a dividend or for whatever reason they're undervalued. So they're kind of going through, and these are people that probably go to estate sales as well, these analysts, because they're looking for deals. They
Mhm.
shop sales and they don't pay full price for anything. Retail is for idiots, and they stick to that belief system. And you want that for part of your money. You want people that are hagglers that are doing that, but you also don't want to miss out on, I mean, I don't know how many years back you'd have to go back on Nvidia to find them at a growth at a reasonable price. Um, but I heard a stat not too long ago that if you had $10,000 in Intel 10 years ago and $10,000 in Nvidia, the $10,000 in Intel, and the dates can make liars out of all of us, as Brian said. So, just stick with the story. 10 grand in each company, the 10,000 with Intel still worth $10,000. And meaning it went down, it's come back up, whatever. And the 10,000 invested in Nvidia is worth $3.5 million. So you don't want to miss out on that either, right? So a lot of people, there's a lot of good discounts out there on a lot of companies right now. Nike, well, I probably shouldn't talk about companies, but Nike, Disney, and a handful of others are at a deep discount. And that's worth consideration or worth your consideration. Talk to your financial advisor and
Yep, not
they can
not
help you with that.
financial advice, especially on individual securities. You could put someone in the market and, like I said earlier, have a very reasonable basis of saying they're gonna, um,
But
there's lots of historical data on the S&P 500, how it has performed. You can't guarantee that it will do that in the future, but we can kind of plan around that, right? But buying individual securities is a whole kind of different ball game, because in order to find that one Nvidia, you could have gone through hundreds of other
Yep.
stocks, losing money, something like that. So
Yep.
it's
I'm a
all risk reward.
I'm a huge believer in the fact that people should have their own portfolios that have, the S&P 500 VOO is the best, most economical way to buy it because it has the full dividend. Yeah. Costs you 3 basis points. And QQQ, okay, the Nasdaq 100, that's about 20. But the bottom line is that you have to hold that. You have to leave it alone and you have to be disciplined, but you should also have professional management. Again, you should employ several different strategies. And that's not just among the people who are assisting you. I just gave you, advice on people advice right there on their portfolios should contain that. And they shouldn't be paying a lot they shouldn't be paying us, 100 basis points to do that for them. That's a freebie. That's on us. Enjoy, but stay the course. Don't try to time the market. When it comes to more sophisticated strategies that involve lots of investments, which include annuities, which we use to mitigate risk. We love it. It's worked for 35 years. It's extraordinary. And whenever we deviate from that, we get punished. And so the bottom line is that you need people like us to help you with fee-based wealth management, with annuities, and with estate planning, insurances, super Roths, all different types of things. But you could also do some things on your own. And then if we're your manager and you come to us and say, hey, should I sell? And we can help coach you on that. As I always say, the greatest people in any field have a coach, have a mentor, have a sounding board. I used to use like Michael Jordan and Tiger Woods as examples, and there's so many examples today, but they all have coaches. They all have mentors. They all have people that they talk to. No one can do it alone. And I get a kick out of people that think that they don't need us. And it's just like, man, I have a spot for them. It's called comeuppance. because they're going to find out. And, you know, there's a FAFO.
So thank you for that. I think we were all very passionate about that one. Number 4, these all kind of tie in together. No one knows what the future will bring.
Yeah.
Yeah,
Uh,
I think that's true
yeah.
about a
So
lot of
no one,
life.
no one knows what the future will bring, right? No one knows.
Yeah.
So
Yeah.
what do? You have to diversify. And that's one of the other ones that leads into. But because we don't know what the future is going to bring, this is the only industry I know of where if someone loves horse racing, if you went to the track and you bet on every single horse in the race, you win every single time. Think about that for a moment. If that were true, we would be at the track every single day and we wouldn't be on this podcast. But it's not true. But in this industry, it is true. If you're diversified within a number of high quality investments in different categories that yang when others ying and offset each other, where there's always a bull market, this is the place to be, investing in a well-diversified portfolio. I used to be in real estate before I was in this business in Southern California, Burbank, Hollywood Hills, Toluca Lake. And when the market collapsed in 1990, that's why I'm here, because there it was depressing. It was a recession. The market came down a ton, and if I wanted to move to a hot market, which there were still hot markets around the country, they were just very hard to find. I would have to start over entirely. I'd have to have a new client base. I'd have to move. I'd have to leave my friends and family. And I thought, wow, wouldn't it be wonderful if there was an industry that I could be involved in where at every point in time, there's always a bull market somewhere in the world. And this is it right here. There's always a bull market somewhere in the world among the different investment groups and categories 100% of the time.
Great. I mean, geez, we've covered a lot of great topics. I mean, all investments go up and down, cyclical in nature, so don't be surprised when either happens. Most people do the wrong thing at the wrong time. Investors often buy high and sell low due to poor timing. I mean, it's time in the market, not timing the market. Um, if you try and time the market 100 times, you're going to be wrong most of them. And that's, pretty important to take note of. Markets usually overreact both on the upside and the downside. It's just that, nature of volatility. You're going to see it. You want to, sort of mitigate it. Don't be surprised when it comes. If you prepare for it, then you can weather that storm, but you want to have a kind of a plan around how you're going to deal with that. Because markets will go up and down, and when they go down, they can go down for several years. And no one knows what the future will bring. It's inherently unpredictable. Yeah, I mean, we can do our best to forecast and project, but that's why we say history may only be a guide. There's no, guarantees as to what tomorrow brings. So, once again, you just want to kind of make sure that you're planning around these things. Um, yeah, I mean, those are some great kind of topics, and if you can keep those in your mind when you're creating a plan, then you'll be in a pretty good spot, I think. And of course, if anyone needs any guidance in terms of planning around these items, or you just want to kind of second look at everything to make sure you didn't miss anything, we're happy to help.
Great. Well, thank you guys so much for joining me today. And thank you, listeners. Stay tuned for part 2. And of course, write in if you have questions. We'd love to share them on this podcast and get your questions answered. And also head to annuityfy.com for additional resources, or to contact an agent. We'd love to help you.
And hit the like and subscribe button.
Yes.
Oh, yeah.
That as well.
Yeah. Smash it.
That's a wrap on this episode of Conquering Retirement with Annuity FY. Ready to take control of your future? Call 1-866-223-2121 to speak with one of the guests on our show and get your questions answered today. Visit annuityfy.com for more information and to contact us online. Follow the show and make sure to turn on notifications so that you'll never miss a tip, strategy, or breakthrough moment.